Welcome, everybody. Merrill Chandler here, your guest with a guest pass to the Get Fundable universe. I talked myself into a corner there. Okay, so first things first. Today, this Tuesdays at this time, we have our kind of industry update. It's the truth you trust with current events. Now, I subscribe to like a bajillion banking newsletters, lender newsletters. I'm on the email list of this is how I get to be able to attend the Fannie Mae and Freddie Mac and the FHA symposiums, things like that, right? So we've got some exciting, it's revolutionary news that's going on in the banking space. And a lot of people did not believe that this would ever happen. But let's start with a couple of definitions first. So you got lenders, remember, and if you've been to the boot camp, read my book, there's four tiers of lenders. Tier one are the top four banks: Chase, Wells, Bank of America, and oh, by the way, Chase is now going by JP Morgan Chase, but in all the records now they call them JP Morgan. So we've got JP Morgan. So I'm going to start using that more and more, but that's what we refer to when we say Chase. So JP Morgan, Bank of America, Wells Fargo, and Citi, right? Citibank. So those are the top four. Then you've got your regional banks in tier two. You've got your credit unions and your national scope credit unions, your local credit unions, and your big savings and loans, the Penn Feds, Navy Feds, and all the local credit unions and community banks. They're in tier three. And then finally in tier four, you have finance companies. Well, now those are the grades of all the lenders. Well, FinTechs came along, financial technology companies, who are kind of putting nitrous oxide, right? They're putting nitrous on the banking and the lending environment by making it super automatic underwriting. They're the Marcuses of the world and the SoFis, right? The Cabbage lending, etc. These are all, and they've been graded in tier four because they're finance companies. Now, the interesting thing is that even while their contracts are based on finance contract tech, right? The vast majority of those fintechs have been funded. The money they're lending out are actually private equity. Meaning, in FinTech's example, there are two levels of investment. You can invest in the infrastructure of the business and own a piece of the business, but you can also lend your money to their pool that's then lending it to borrowers, right? When they first came out, I wanted to try it out, find out kind of how it works and all that, and so I did a SoFi loan, $50,000 SoFi loan on my personal profile. So it contributed to my fundability, but it ended up giving me a tag on my profile. I'd never had one to date. So that's why I always say I'm my own crash test dummy. I'd never had one until that moment where I received a consumer finance account negative indicator from FICO. Perfect record up to that point. And I get a SoFi loan, and now FICO downgrades me with a consumer finance account on your credit profile. And just as an aside, those stay, as I say in my boot camp, they stay on your profile, literally stay on your profile after the account is closed. I still have a negative indicator on my profile, and my SoFi has been closed for years. So the next thing is, but SoFi is an example. Marcus, all these different groups are examples of fintech companies. Now, these fintech companies have been looking at buying banks so that they can become more legitimate. Now, bankers don't want more competition. The tier ones and the tier twos, they don't want anybody else in this space, but they do. But these fintechs have they keep, in the articles that I've been reading, they talk about an uneven playing field because they're not regulated. These fintechs are literally lending billions of dollars, personal and some business, and they aren't governed by the same rules. Tier one and tier two banks part of the reason why they're tier 1 and tier 2 is they're governed by what's called the Office of the Comptroller. Okay, this Office of the Comptroller regulates these types of banks and gives out what are called charters. You to be a charter, to be a part of the financial, the legitimate traditional financial institution like depository banks are, you have to have a charter. To get a charter, you have to submit to certain regulatory conditions. FinTechs have never had to do that. And I do want to, Michelle Alt, who used to work in the Office of the Comptroller, said this, and it was hilarious, and I wanted to read it because she was I can't use better language. She said, a senior federal banking regulator once joked that when representatives from FinTechs visited him in Washington, after he finished explaining to them what the regulatory implications of becoming a bank were, the FinTechs ran screaming from the building. Okay, so they have created private lending in order to move away, not be regulated like by the Office of the Comptroller. Well, there are also benefits for being part of the banking. Right now, they're lending money that investors have lent. Whereas if you're part of the charter, you can borrow from the Fed at what, 0.5%, but 0.6% right now, and then lend it out. So there are, instead of having this, instead of paying this huge ROI to private investors, everybody following me? So they have enough momentum now that they're like, well, maybe the regulatory constraints wouldn't be so bad if we can get 0.5% money instead of high interest money from all of these investors. To do so, the organizers or the owners of these FinTechs are like, whoop, I want to join. I want to get a banking charter. So good news, bad news, for borrowers, more competitors means more opportunity, because the regulation in this market, as long as everybody's dotting their I's and crossing their T's when it comes to capitalization requirements and loan to balance, loan to deposit ratios, all those things, now FinTechs would have to obey those same rules. They don't have to do that now. They don't have to be capitalized to any degree because it's private investor money being dumped into the borrower marketplace, right? Well, there is a high yield on borrowing money from the Fed at 0.5%, you guys. So that's what's on the horizon. Now, the bankers on the other side, the tier 1 and tier 2 banks, they haven't been super friendly, but they would like the payoffs for giving these guys charters, the FinTechs getting charters, is that now it's a level playing field. They're not out there. FinTechs aren't out there kind of scrambling the eggs of the marketplace and making it a more difficult lending field among banks. And so there is good news to this. Now, there is and it happened recently, about a month ago, I think 4 weeks ago, there was an announcement that the FinTech bank, one FinTech bank actually tried to buy a bank that already had the charters, and that's now the latest that I've heard is in litigation, that it got tied up in a regulatory mess because the FinTech actually wanted to be able to purchase this bank and kind of back their way into the marketplace instead of getting their own charter. So a lot of things are going on. Now, to add to this maelstrom, this craziness that is going on in banking. Now, by the way, from a fundability standpoint, you guys, this is all amazing news. All of it. Spectacular news. Because automatic underwriting, if you pulled any one of these fintechs, they're FICO sensitive, right? They pull a soft pull, see if they want to lend to you. You fill out the rest of the application, and they approve you with a hard pull. Well, if we're going to get all of these people, all these new organizations, all these new finance companies, if they're trying to upgrade, then they're going to be at least tier 3, but depending on their charter size, or they're going to become tier 2 banks. That gives tier 2 banks more momentum or more pressure to move into automatic underwriting, because I've told you the story. SunTrust Bank, way back in the day, they've merged. Part of the merger of SunTrust Bank into the new bank was because they could save money in automatic underwriting. SunTrust Bank was not a heavy, they were doing everything in manual underwriting. And as I've shared with you, the vice president, when I was at FICO World, the vice president of SunTrust Bank gave a presentation saying that it required, to break even on a manually underwritten loan, to break even, they had to do it was a 36-month term minimum, a prime plus 4% minimum, and a $38,000 note amount, a loan amount. That was to break even. So they actually merged with another bank to create a newly branded bank heavily in the Southeast. But the point of all of this is that everybody's moving to automatic underwriting, but there are a whole bunch of tier 3 and tier 2 banks that have been really slow. They're still doing it the old SunTrust model, and they're just manually underwriting everything. So if we get a whole slew of new fintechs coming into the banking space, and they're already pros, they got their automatic underwriting down tight. If they're coming in to this space, then to even be competitive, these old depository banks, the tier 2s, tier 3s, even some community banks and credit unions are going to all have to level up. That is brilliant for us, because when we know what the funding models are, right? We know what it takes. Imagine being clearly in your mind, imagine being able to walk into any financial institution and know that you're going to be approved, because you know what they're looking for you to be as their perfect customer. And you have taken the steps to become their perfect customer. You don't even apply unless you know you're approved. That is the power of fundability. And these fintechs coming into the space, these fintechs coming into the space, they're badasses at automatic underwriting. They just don't have bank charters. They're not depository institutions yet. Tier 1s, all tier 1s are automatic underwriting. Many tier 2s, but not all. And most tier 3s are not automatic underwriting. You still have to get a car loan at your credit union. You still got to show your pay stubs. You still got to show your documents, right? For many or most. Now, let's throw a wrench in this whole process, because it's not just fintechs that are coming into the banking space. Okay. Walmart, the largest retailer in the world, has made announcements that as of 2 weeks ago, has made announcements that they are going to do this. They are fighting to get a charter just like the fintechs are, so they can have a bank and have their own bank inside of every one of their stores. Guess which market they're targeting? They're targeting the socioeconomic class, the financially economic class of invisibles, right? Those who don't even have a credit score or a credit profile, invisibles, and low to medium income credit light, people with very light files. Well, we already heard from Biden, whose proposal was to create a new credit bureau. It's all BS that they wanted to replace the credit bureaus. They wanted to create a new credit bureau that collected data that is not about credit payments, mortgages, auto loans, etc., but create that measure leases, cell phone payments, etc. Because the the discipline of the human being, the borrower behavior to pay a cell phone bill on time is the same borrower behavior to pay an auto loan on time, right? So Biden's proposal to get a brand new a credit bureau is not to replace the one in the credit markets. It's a new one that's going to address the 50 million. FICO estimates that it's over 53 million invisible borrowers, right? Potential borrowers that are completely invisible to the credit markets right now. That is a huge marketplace. So guess who's going after that with a vengeance? One of the first subscribers to this new credit bureau idea, a national financial registry, I believe is the technical term. Let's use the terms that help us understand what it is. This new credit bureau does not use credit trade lines to evaluate the borrower. It uses other trade lines. Walmart wants to be in that game and wants to evaluate borrowers, but wants to be a financial institution to their already marketplace. They are a trusted name among their buyers, right? Among their tribe. And so they also want to get in the lending game. Now they've had ancillary institutions that would refer out, etc. This is a move from Walmart. I believe one of the sons of Walmart actually has a financial institution, but it's been kind of a third party, similar to the FinTechs, where it's just it uses mailing lists and access of their clients, of their shoppers, in order to attract them to a market. That is very different than dropping a brand new branch into a Walmart store and being able to offer a full service experience for their shoppers. That's a huge market, and it's currently relatively untapped because you got to have a credit score, you got to have a FICO score in order for the current tier 1 through 4 lenders to lend to you, right? Exciting times. This is all good news for Fundability. Not only am I committed to those 53 plus million borrowers, because Fundability, whether you're paying your lease payment, your rent payment, your cell phone bill, your utility bills, I don't care what you're using. My job is to help you establish a profile that will ultimately lead you from becoming a potential borrower or an invisible into becoming part of the larger credit system that gives you even cheaper rates and more opportunities. So go Walmart, right? There's a lot of things people can say about a lot of things, but if it comes to sheer business acumen, sheer business foresight, they're already sitting on tens of millions of potential banking customers already walking through their door every freaking day. So a lot of great things going on. So that's our that's our way to this. There was another article that was so fascinating. I won't go into it, but the title of the article is How FinTechs Buy, Rent, and Fight Their Way into Bank Charters. See what I'm saying? These are the types of things that are so fun to watch, because remember, banking has been a 500-year stodgy, slow industry, right? And now it's going to be the FinTechs are bringing aggressive rates, aggressive terms, a super pro borrower. Banks are going to have to keep up, and you heard it here first. Keep coming every Tuesday at 12:30 Mountain Time, except for next week, because I'm out of pocket. I'm going to be in a meeting. But most Tuesdays, 12:30 Mountain Time. This is when we do our financial update, what's going on in the markets, and things to watch for that are going to help you power through your fundability. And whether you're currently a potential borrower or whether you're a borrower yourself, I got you. Fundability is the key to your current and future success. This is Merrill Chandler. Make sure you like, love, share. If this was important to you guys, come on, go share this to friends. Make sure that they know that this is happening and what's going on here. All right, guys, I will talk to you on the inside.